On the next couple days as we closed out near multi-week highs on Friday. Let's talk about the situation with Mr. Jim Bianco, president at Bianco Research. Jim, good morning. Good to have you here.
Thanks for having me.
Hey, Powell going to say anything this week, or is he got to keep kind of mum on inflation and upcoming policy changes when he's talking to D.C. instead of the academics or the traders?
No, I think he has to. I think he has to at least give a consistent message that the inflation fight is not over. That's the message he has been giving, and that the market, at least if you look at Fed fund futures, maybe SOFR options, the market's looking for, maybe as high as 5.50 to 6% on the funds rate by the end of the year, 5.50 by the middle of the year, maybe 6% by the end of the year. So his fight isn't over, and I think he has to communicate that in Washington. I think the tiptoe he's going to have to say is, we could do this, raise rates that much, and we can fight inflation without creating a whole bunch of unemployment. That's what I think Congress is going to be most interested in hearing from him.
And generally, do you think that we've started to price that in more in the last month? Because we had that big pop when he spoke in February, but it didn't go anywhere. We've reversed it all since. What do you make of the way we traded last month?
Well, I guess it depends on what we're talking about. If we're talking about Fed fund futures and short-term interest rates, their highest percentage ever of pricing in an aggressive Fed was Friday. So they've been pricing in more and more of an aggressive Fed. They've already got about a 30% chance that the Fed will raise 50 basis points at the March 22nd meeting. That could, that's middle of next week. And that could happen with a strong payroll report and or CPI or very hawkish Powell, and that could go well over 50%. So at least on the interest rate side of this equation, especially short term, they're definitely pricing it in. Now, long-term interest rates and in the stock market, hopium lives. Hopium is that the Fed is going to start to maybe back off of this dovish talk. I don't think they're quite all the way back to pivot yet. But, man, is this like the fifth or sixth time that the market has rallied on this whole idea that the Fed's going to back off, in the last year or so? And it never really does. And I don't think the Fed will until they get solid evidence that 2% inflation can become a reality. And after last month's data, that's not a reality right now.
Powell likes to say he's data dependent. Last month was a deviation from the disinflationary trend he was citing when he spoke in the first week of February. Do those data points from last month's inflation constitute enough for him to be dependent on? Technically, they're kind of like one data point away from the disinflation trend off the highs, but they were multiple within that one instance of the month of February, because it was PCE, it was PP, it was CPI. It was everything.
Right, and payrolls at 500,000 as well, too. Yeah, so yes, I think you have to really frame the question that Powell's been asking himself. Is not as inflation peaked? That it has, and that's not his story. The story is it going back to 2%? And I like to say organically. That means without a recession to depress it to 2%. And the data that we saw last month, and with the strong payroll report, with another sub 200,000 on claims, because he's so focused on the labor market, he's got to question whether or not we're going to get all the way back to 2%. And if we don't, then he believes that Fed policy has to stay sufficiently restrictive, to use his term, and that means that they're not going to be looking at backing off. Now, they might be looking at peaking on rates at 5.25, 5.5, but that's all they'd be looking at doing is peaking. They're not looking at any kind of rate cut, at least in this calendar year, maybe 2024, if the data changes.
Okay. What about the potential for this no landing concept, Jim? I feel like people either love this concept or they hate it. How do you describe the outcome that you see as most likely in terms of the relationship between the strength of the labor market and inflation?
Yeah, I think they hate it because they just hate the phrase no landing. And because I think a lot of people don't know what that means. And I'm going to define that as there's no slowdown in the economy. There's no, that the economy just continues to go without coming in for any kind of a landing. And I think that the data is continuing to point in that direction. Yes, we got 500,000 jobs in January, and yes, that was probably a number that was overly inflated. But let's say that the consensus is right about this Friday. They're at 200,000 for the consensus. So if we go from 500,000 jobs in January to 200,000 jobs in February, considering that for population growth and everything, we only need about 75,000 jobs, that's a no landing scenario. That is, the economy's doing fine. You've had 500 basis points of rate hikes. That means we're not even at neutral. Maybe we'll throw a few hundred more at you. I'm just kind of being sarcastic, get my point across. But the 500 basis points of hikes has not hurt anything, is what that no landing scenario suggests. And I think that that's the risk that the Fed looks at. Look, we've done 500 basis points from 0 to 5%. And we're just rolling up our sleeves right now. And we're just now starting to think about getting to tight policy. I think the market is way ahead of that. The market's thinking that we got the tight policy months ago, and that we're now worried about that the economy is going to, crash in a hard landing or a minimum of a soft landing. And that data is not panning out, or the data is not panning out for that right now.
So does that mean that we could potentially get a push higher in interest rates? So let's say the 10-year past 4%, if the markets got a little bit too concerned about maybe the drop off for the economy. Obviously, yield curve got trashed, but if employment's too strong, does that mean we get another leg higher in interest rates?
Yes, I do think it does. Take short rates for starters. Every rate hike cycle back to the 80s, the 2-year yield peaks above whatever the terminal rate is. If the terminal rate is going to be 5.50, that means the Fed raises rates 3 more times, then the 2-year yield, if it holds its historical pattern, should peak at something above 5.50. It's at 4.85 right now. So it's got another 65 basis points minimum, and it could go even higher than that above it. I think that means in that kind of scenario, the yield curve parallel shifts higher. We got the 407 on the 10-year last week. 424 was the high in November, so we were 15 basis points from the cycle high. I think what we've got now is a short squeeze or short covering going on in interest rates, or in the 10-year to be more specific, and that in the next move higher, we're going to go well above 5% in the 2-year note and parallel shift the whole curve higher. And I wouldn't be surprised if we at least get to 425, if not even push 450 on the 10-year. I don't think the rate hike cycle is over, and I don't think that the move higher in interest rates is over either.
And do they do maybe another 25 in addition to the 25 increments that were already planned, or do you think one of those 25 could move into 50, Jim? Last point.
Yeah, I think if they move into 50, then that would, if they do a 50 either in March or in May, then they're signaling that they're going to go to 6% on the terminal rate. Otherwise, if they keep doing 25 increments, I think it's more like 550 to 575. So that's the signaling that a 50 would do. Now, it's not, like I said, it's not priced in now, but it's not that far away from being priced in. You get a very hawkish Powell, or you get a big number on payrolls or CPI, and in a week, that could be a different narrative.
All right. Great convo, Jim. Thanks for the thoughts.
Thank you.
Appreciate it. Jim Bianco, president at Bianco Research.